Good morning, good afternoon, or evening, depending on where you are, and welcome to this new session of the International Macrohistory online seminar. My name is Stefano Battilossi, Carlos III University, Madrid, and I am pleased to introduce today's speaker, Victor Degorce. Victor is just about to complete his doctoral studies at the École des Études en Sciences Sociales in Paris under the supervision of Eric Monet and Sébastien Le Chevalier. And he has just started a postdoc at the Ulis Rabinovich Center for Public Policy and Finance at Princeton University. His research interests include the international transmission of monetary policies and the determination of exchange rates in a long-run perspective. And today he will present a paper on public credit and the financial cycle. Before giving the floor to Victor, let me briefly remind you the rules of engagement. Victor will have 40 minutes for presentation, followed by 20 minutes for discussion. Please write your questions in the Q&A window, and I will collect them and then pass them on to the presenter during the discussion. If you have short clarification questions during the presentation, please flag them also through the Q&A, and I will briefly interrupt Victor in order to allow him to respond. And as usual, after the formal ending of the seminar, we will have 15 extra minutes for a more informal interaction between the speaker and the audience. With no further delay, Victor, the floor is yours.
Right. Well, thank you very much. It's great to be here. So let me share my screen. Right, this should be better. Is it fine like this? Yeah, it should be.
Yeah.
Perfect. So thanks a lot for having me. So this article is part of my PhD, Public Credit in the Financial Cycle. So what I do in this article is first a data contribution, right? Is that I collect something that has not been collected before, and that something is credit granted by the state, by state institutions to the private sector, so to firms and households. This is what I call public credit, and this is what I'm going to be calling public credit throughout the rest of the paper. So the data set is quarterly. It covers 70 years of data since 1950, and it covers 13 major economies. So there's 9 developed economies and 4 emerging economies, right? And this data comes from, I'm going to be a bit more specific in a minute, it comes from central bank's archives and central bank statistical reports. So there's 3 main results that I put forward in this paper. The first result is that, well, public credit matters, right? It's not just an historical detail. It's a large share of total credits. On average, across my sample, it's 22%, more than 1/5 of total credit, right? It was even more before the 1990s. It declined after the 1990s, but still today it's around 1/6 of total credit. Second thing, I look at the behavior, the macroeconomic behavior of public credit, and I show that it's very different from the macroeconomic behavior of private credit. So the first thing I do is that I look at its reaction to global financial cycle, which is I look at the reaction when the US tightens or loosens monetary policy, right? And private credit is very affected, public credit is not. Private credit contracts following a US monetary policy tightening, public credit increases a bit or stays stable. Second thing, I look at domestic credit cycles. And in financially developed economies, I'm going to be a bit more precise in a minute, but by what I mean by financially developed economies, I see that public credit is very countercyclical. It expands during private busts and contracts during private booms. And this matters for the real effect of private bust. I show that the real effect is lower when the ex-ante size of public credit is larger. So in fact, public credit serves as a buffer against private credit contraction. And what's very important is that this result is specific to financially developed economies. In financially repressed economies, and I'm going to be a bit more specific again what I mean by this, public credit is very procyclical. It booms with private booms and it busts with private busts, and it does not buffer the real effect of private bust. So let me say a bit more about the related literature. So of course, this now very well-established literature on the global financial cycle and domestic credit cycle. There's two main findings that are, again, very well-established. One is that private credit cycles have a strong international component, the global financial cycle. They're all tied across countries. And second thing is that private cycles can be hurtful for economic growth, right? Most private busts end in a booms, and when they do, it's bad for economic growth. So that's the two key findings I'm going to be challenging looking at public credit, right? And of course, it's quite relevant doing so because, as I just said, like public credit is not just a detail, it's 1/5 of total credit. And second thing is that it tends to focus on borrowers that are really the borrowers that matter for the aggregate transmission of credit cycles. Borrowers that are close or below the credit constraints, meaning people that struggle to get loans from private banks. That's the one that usually get loans from public banks. And that these guys that matter when it comes to analyzing the real effect of private busts, right? I'm going to say a bit more in a minute. Of course, the second strand of the literature my results speak to is the literature, which is more a micro literature, it's not a macro literature. And it's about whether public loans can be efficiently allocated. So there's been long-standing debate between economists, and one side following the contribution by CEPR and his co-authors saying like, no, like public loans cannot be well allocated. There's corruption, there's no incentive for public banks to allocate well public loans, so it's badly allocated. There's another side in the following Stiglitz and other people who say, no, they can solve market failure. I'm not going to engage into that debate. I'm just going to look at the other side of the debate. I'm just going to say, look, it's not only a micro debate about whether public institutions are able to allocate funds efficiently, it's also a macro debate. I'm just going to look at the macro behavior of public credit, which is something no one has done because no one essentially had data, aggregate data on public credit. So let me say a bit more about what exactly is public credit. So public credit is granted by a large variety of institutions, depending on the country and sometimes within the same country. Government agencies, for example, in the US, public funds, specialized credit institutes. The most famous type of institution probably is development banks. I'm going to say a bit more in a minute about how I select these institutions. And of course, they have some common characteristics. So the first key thing is that they have public policy objectives. They're not for profits, right? They have a goal which is assigned to them by the state, which is not to make money. It can be to develop a certain territory, it can be to target a specific type of industry. It's not for profits. That's the first important thing. Second thing is that most, let's say 90% of the loans they grant are long-term loans. And they tend to focus on the same type of sectors. Again, it's sectors in which people have a hard time obtaining loans from private banks. Housing, especially like poor households, agriculture, export industries, small and medium enterprises. Again, it's quite impressive to see across 70 years in certain countries, it's always the same sector involved, always. And the second thing is that the loans that they provide, they're not only long-term, they're also cheap, they are below market rates. And again, I'm going to explain how they provide below market rates loans in a minute. There's some concerning the funding of the institution, there's two different regimes, right? Before financial liberalization, and again, I'm going to explain why in a minute, they tend to be funded by special financial circuits. So these circuits are very sheltered from the market. They have a large state subsidy involved, for example, collecting postal savings, collecting fiscal receipts or loans from the central bank. More recently, since the 1990s, they started to issue long-term bonds in the market. And these bonds are guaranteed by the state, which means that they sell at a higher price than private bonds. And this has important impact. Again, I'm going to explain all this in a minute. So just to give you a brief overview of what I mean by public credit institution is what I mean by public credit institution for every of the 13 countries in my sample. So probably some of you are very familiar with some country-specific history and might already wonder why this type of institution is included, why this other type is not included. For example, those who know very well German history might wonder why Landesbanks are not included. And in fact, it's not me who chose which institution to include. It's the government or the central bank. I just follow the classification of the central bank or the government. And again, I'm going to say a bit more in a minute. We'll come back to this. Don't worry, we'll come back to this. So let me say just a word on data contribution. So again, it's the first time that they aggregate data on public loans are constructed. Data on public loans is most of the time not included in data existing long-run series of private credit. Why is that? It's because the long-run series of credit, for example, the Jordan, Schulark, and Taylor database, the IMF International Finance Statistics, the BIS, they report loans granted by banks. And the definition of banks is institutions with short-term liabilities, for example, with short-term deposits on their liability side. And that effectively excludes most public intermediaries which are funded with long-term resources. Again, savings deposits, fiscal receipts, that doesn't even qualify as a liability, in fact. Fiscal receipts or long-term bonds. So there's some overlap. There's definitely some public institutions that are included in a series of private credit. And I try to clean this off. And again, I'm going to say how in a minute. But there's a minimum overlap, right? So how do I collect this data on public credit? Well, I rely on central banks' archives and central bank statistical reports. So sources coming from central banks or sometimes from government statistical offices. And importantly, in these sources, the distinction is already made. The public credit institutions, they're already grouped in a separate category. I did not make the choice. They made the choice. We can discuss about like the cutoff, which is kind of arbitrary in some circumstances, but it's not my cutoff, it's the cutoff of the central bank. They're already grouped in a separate category, which is labeled, depending on the country, public credit institutions, public loans, specialized credit institutions, development credit institutions. The terminology can vary from one country to the country, but it's always the same type of institutions that are grouped in this group. And importantly, it always excludes nationalized commercial banks, right? It's not enough to be public, you have to be non-for-profit. And again, it's the central bank that makes the choice. Let's have a look at the long-term pattern. So this is public credit as a percentage of total credits in the 9 developed countries in my database. So we can already see something that's going to be with us along all this paper is that there's kind of 2 periods, right? There's the golden age of public credit, which is during the 1950s, 1960s, 1970s, and then it declines starting in the 1990s with financial liberalization. And the reason for this is that during the pre-financial liberalization period, well, essentially all the long-term credit in the economy is public. If you want to get public long-term loans, you have to go through public credit institutions. Stock and bond markets are very repressed. Commercial banks are often prevented from granting long-term loans. So there's a clear market segmentation. Public long-term loans are public, private loans are short-term. So we can see this pattern, for example, in France, where there's a reform in 1994, which explains this sharp drop. Same thing in Italy, same thing in Greece, Japan, Norway. The spike you see here for Germany is German reunification, and there was a huge increase in public loans during that time. So that's the broad pattern we see for developing countries. But still, like today, public credit is more than 10% of total credit. This is the pattern for emerging economies. I included South Korea as emerging economies because it was emerging for the most part of my sample. And that's because it's emerging today. And again, we can kind of see the same pattern, but at the level are higher today. They are around or above 20% of total credit. And again, total credit is calculated as the sum of private and public credit. So the first thing I do once I document this kind of global trend is look at the macro behavior of public credit. How does it behave? How does it react to macro shocks? First thing I do is look at the global financial cycle. So the empirical specification is very standard here. I just restrict my sample to the subsample of open pegs, meaning countries with relatively open capital accounts and fixed exchange rate. These are countries for which we expect, and we know, that private credit is very sensitive to foreign shocks. And I'm going to be asking, well, is public credit also sensitive to foreign shocks? And I use 2 different sources of 2 different measures of foreign policy shocks. The first one is that's the one I'm going to be using in my baseline specification. It's the residual from a regression of the first difference in the country's 3 months interest rates on domestic controls. And the second one is the measure by Romer and Romer that's been extended by Miranda, Agrippino, and Rico. And I don't use it in my baseline specification because it restricts my sample to only the countries pegged to the US, not to Germany. So I only use it in my robustness check. And I start, so that's the sample of open pegs. I start with a relatively broad definition of what is to be open. So only countries that are completely closed are excluded. So that's
sorry, Victor.
Yeah.
Sorry, Victor. There is just a short question by Simon von Norden. He asks, do public loan guarantees show up in the statistics?
No, they do not. Only loans, that's a very good question. Only loans that are granted, not the loans that are guaranteed. No.
Okay, and the connected question is, after liberalization, did public loan guarantees play any significant role in some countries?
Yes, they do, especially today. But my database does not include any data on loan guarantees. And in fact, you'll have to go through different types of sources to have data on loan guarantees. So I think that's another paper, but we can discuss it at the end. But yeah, very important, it does not include loan guarantees. So that's the regression I'm running again. So this is a local projection, it's very standard, there's nothing new here. So I'm looking at the response of a real credit aggregate, to be more specific, of the growth rate of a real credit aggregate, which is this variable credit here on the left-hand side, to a shock at time t on the foreign interest rate, which is that variable RBIT. Okay, so I'm just going to look at the response of the real growth rate of total private and public credit to a shock on the foreign interest rate. The controls that I include are the controls that are included there, pretty much everywhere in this kind of specification. So world GDP, domestic GDP, inflation, long-term interest rates, stock prices, and so on. So of course, I'm going to be interested with beta here, with beta 1, beta 2, beta 3, meaning the response of private credit at times 1 year, 1 quarter after the shock, 2 quarters after the shock, 3 quarters. So let's look at the first result, right? So you see that on average, the growth rate of real private credit is 2 percentage points below what it is in normal times after a shock. That's the left-hand side panel, this panel A. Public credits, you do not see at all this response. And interestingly, like the response of total credit is half that of private credit. So when you include credits, it divides by 2 the response of total credit. Now, if I'm a bit more strict on what I mean by being open, so if I focus on countries that are only like perfectly open, this is what I get. So as expected, private credit becomes even more responsive, right? The response is 4 percentage points against only 2 percentage points, okay? But still, it does not affect public credit. In fact, public credits, like the standard errors, tends to span mostly the positive side. I cannot conclude that it's positive, but it's more positive than it's negative. And again, the response of total credit is half that of private credit. And this has very important policy implications for what is meant by monetary policy independence and the global financial cycle. I'm going to say a bit more in a minute. So why does this result make sense? There's different series of reasons why, in fact, it makes sense that public credit markets are not affected by foreign interest rate shocks. The first reason is that, well, interest rate on public loans, they tend to be below market rates, and they also tend to be much more stable than market rates. And even when they track market rates, since they're below, that allows public credit institutions to do credit rationing, meaning like they can increase the interest rate and also increase the quantities of credit they grant at the same time. I have example in the appendix, and we'll go through it if we have time. Second thing, there's another, of course, the interest rate channel is not the only channel by which the US monetary policy affects domestic financial conditions. One is the credit channel, meaning that an increase in the Fed interest rate causes a deterioration of borrowers' financial conditions. In other words, banks are less willing to lend to the same borrower or require a higher interest rate after an increase in the US. Well, we can expect that it's not the case for public credit institutions because they're specifically designed to assist borrowers with inadequate collateral, meaning people who have a hard time obtaining funds from private banks. Same is true of the risk-taking channel, but I'm not going to spend too much time on this. We can review these reasons at the end. Right, so this is for the global financial cycle. Second thing I do is that I move away from the global financial cycles and I look at domestic credit cycles. Because of course, domestic credit cycles are not only driven by what's happening in the US. There's a large share of variation in domestic credit cycle, which is purely domestic. So what we know from the literature is that credit booms, they often end in busts, and when they do, it's bad for the economy. Can public credit change anything to this narrative? So what I do first is that I start with very descriptive data on public and private booms. To identify credit booms, I rely on the procedure introduced by Shurarik and his co-authors in 2021. And the idea is just to regress the log of real credits on its lagged value and to look at the residual. So I'm going to be interested by the residual epsilon here, right? So I'm going to be running this regression for each country and for each type of credit aggregate. Meaning I'm going to I'm going to run this regression for France for public credit, for France for private credit, for Germany for public credit, for Germany for private credit. Okay, and I'm going to look each time at the residual epsilon t. Let's start with some descriptive statistics. Using this, and of course, I'm considering that there is a boom when epsilon t is larger than the country-specific threshold, which is defined in terms of the country-specific standard deviation of epsilon. Let's start with some descriptive stats on public and private booms. So this shows the number of private booms, number of public booms, and the average length of both types of boom across all the countries in my sample. If you look at the last row here, you can see that there's not much difference, right? The number of private booms and the number of public booms is pretty much the same, and same for the length. So looking at basic descriptive statistics does not tell many things, like public booms are not very different from private booms. What's going to be more interesting is to look at the timing of the two booms. If I do a simple event study where here on the y-axis is epsilon from this regression scaled by its country-specific standard deviation, so I can compare it across countries, right? And the interpretation is exactly the same. When y goes into the positive, it means there's a boom. When negative, it means it's contracted, right? Okay. So here we see it's the year 0 is the year of the peak of a private bust. So we see that 4 years around the peak of a private bust, private credit is booming, which is not surprising at all. And during all this period, public credit is on average stationary. Okay, what does this mean? Well, in fact, the blue line here is kind of averaging out two very different behaviors. In one case, public credit is very procyclical. In another case, it's very countercyclical. Let's look at country-specific case studies to shed light on this. So here, I just depart from the Shulari-Kendall method for filtering credit cycles. I just use Cristiano and Figel's filter. The reason I do this, the result would be exactly the same if I use the Shulari filter. It's just that it's smoother and it's nicer to look with a Cristiano and Figel filter, because you can filter out cycles at like very short-term cycles. So the result is smoother, but it does not change the message. So here again, what is shown on the y-axis every time is percentage deviation from trend. When it's positive, it's a boom. When it's negative, it's a bust. Red line is for private credit. Blue line is for public credit. And the shaded area in all the three figures is an index coming from the IMF, from an index of financial liberalization. The lighter it is, the more financially liberalized it is. So what we see, for example, in Germany, in countries with very liberalized financial system, public credit is almost perfectly countercyclical. On the other hand, in countries with very state-controlled financial system, public credit is almost perfectly procyclical. And the interesting case is more the in-between case when there's time variation, for example, Greece. Well, I'm just showing here 3 graphs, but it's the same for France, Italy, for South Korea. For example, take the case of Greece. It's very procyclical before financial liberalization. As soon as the system is liberalized, it becomes almost perfectly countercyclical. Why is it the case? Well, I'm going to explain why in a minute. First, let me generalize this finding across all the 13 countries in my database. So one way to do it would be to show you the same type of graph for all the 13 countries. I'm just using another methodology, just a simple econometric test, which is I define a variable which takes the value 1 when let me show you this. I define a variable to take the value 1 when public and private credit are both on the same phase, meaning they're both expanding or both contracting. So when they're both on the same phase, it takes the value 1. When they're both on the opposite phase, it takes the value -1. And I look at the expected value of this variable synchronization across my sample. Intuitively, if they're always correlated, then the expected value should be 1. On the other hand, if they're always countercyclical, it should be -1. And to take the expected value, I just run a simple regression of this variable. And I look at the constant, right? Beta 0 here in this regression is just the sample average of variable synchronization across my sample. And I run this regression for 2 subsamples. The sample where countries are financially liberalized and the control where they're financially repressed. And to separate these 2 time samples, I just take the mean value of the financial liberalization index, and I just look at when it's above the mean value or below the mean value. Nothing fancy. And this is just a generalization of the 3 graphs I've been showing you, right? showing that on average, they tend to be on a different phase, public and private credits, when there's a liberalization, and they tend to be on the same phase when there's no liberalization, right? It tends towards 1 before financial liberalization, it tends towards -1 after financial liberalization. In both cases, the null that beta 0 is equal to 0 can be rejected. That's just a generalization of the graphs I've been showing here. So how can we explain this pattern? How can we explain that before financial liberalization, it's very procyclical, after it's very countercyclical? Well, the explanation I put forward, again, echoes these two different regimes I've been describing. Before financial liberalization, again, there's market segmentation, meaning that what's coming from the private sector is short-term. Bonds and stock markets are very restricted. Commercial banks are often prevented from lending long-terms. So public loans are long-term, private loans are short-term. It does not make sense for one borrower to switch from one to the other. There's market segmentation. This market segmentation is abolished with financial liberalization, meaning they can switch from one to the other. Commercial banks are allowed to lend long-term. In fact, it's been documented by Schularik and others that a large part of the increase in credit to GDP in the 1990s was mortgage loans by banks, commercial banks starting to lend long-term. So after financial liberalization, it makes sense for borrower to switch from one type of loan to another. And then automatically this generates this pattern. In the boom phase of the cycle, everyone can get a loan from a private bank. So no one has an incentive to reach to public bank. Public loans decrease. In the bust phase of the private cycle, no one can get a loan from a public bank, from a private bank. Everyone reaches to public banks. Public loans increase. Okay, so that's the explanation I put forward. Of course, it does not entirely rule out the second category of explanation, which is political institutions. If we come back to this graph here, another type of explanation, and it's been put forward in the GPE paper by Herrera and his co-authors, which is that governments with weak institutions can have an incentive to ride private booms. In other words, it's politically costly to monitor private booms. And in autocracies, for example, governments could have an incentive to ride private booms, meaning not to regulate private booms. And in fact, what they could do also is use public credit institutions to feed in the boom. And this could also work, for example, in Indonesia, where there's financial repression and there's also political institutions, in particular before the 2000s, that's much more unstable than, for example, in Germany. But it does not very well explain this time variation that we see here, for example, in Greece, where the quality of political institution was pretty much the same. If anything, in fact, when you look at indicator of political quality, it was better in the 1990s than in the 2000s. But it does not track down very well this change that you see here. But of course, for the case of Indonesia and Germany, I cannot entirely rule out another set of explanation based on the political system. Right, so once I documented this pattern, meaning that in financially developed economies, public credit tends to boom during private bust and bust during private booms, does this has any effect on the real consequences of private bust? Can public credit help mitigate the decline of output and of total credit during the bust? Well, one way of showing this will be to showing that whenever public credit is larger before the bust, the bust is lower. So that's exactly what I'm going to be doing here. So what I do is I start with a sample of private busts, of private booms, and for each boom I calculate the output loss and the credit loss in the subsequent busts. And the way I do this is outlined here. It's not there's nothing fancy here. I just take the difference between the growth rate over 5 years and the growth rate in normal times. So when the loss is positive, it means that output grew more after the boom than during normal time. When the loss is negative, it means that it grew less. So the more negative the loss, the worse the bust, and the more positive the loss, the better the bust. Okay, and then I estimate the following regression over the sample of credit booms. One drawback of this method is that I have quite few observations. I have like 30 credit booms in the financially liberalized part of the sample. But still, it's going to be informative. So what I do is the left-hand side variable is the variable loss that calculates either total credit loss or total output loss. I'm going to do the two. And I'm going to look at beta 1. And beta 1 is the coefficient on share, and share is the ex ante share of public credit in total credit. When share is higher, it means that public credit matters more. It accounts for a larger share of total credit before the bust. When it's lower, it means it accounts for a lower share of total credit after, before the bust. Okay. And I'm going to be showing this. So don't bother with the long table notes. Just follow my steps. So in the first 3 columns, the left-hand side variable is total credit loss. Again, the more positive it is, it means that total credits grew more after the bust than during normal time. When it gets negative, it means it grew less. So what I'm showing here is that, well, the larger the ex-ante size of the public credit sector, the lower the effect on total credit during the bust. That makes sense. That is absolutely consistent with the graph I've been showing you, right? Column 1 is estimated on the financially liberalized part of the sample. If I estimate exactly the same thing on the financially repressed part of the sample, I do not get any effect, right? So that's for total credits. Then starting with column 3, I switch with total output on the left-hand side. And again, if I look at the effect on total output, I see that the effect is much, much lower the larger the size, the larger the ex-ante size of public credit sector. So it does tame the impact on the real GDP. And again, there's no effect at all if we look at exactly the same specification of 3 and 4, but in the financially repressed part of the sample. So this again just confirms the evidence that I've been showing you before, right? Well, it shows that this pattern that I've documented helps alleviate the pressure on constrained borrowers and matters actually for the path of real GDP and real total credit during the bust. So let me conclude, because I think I'm pretty much reaching my time limit. Let me conclude. Sorry. Let me conclude by the policy implications of this finding. If we go back to the finding on the global financial cycle, what does it mean? Well, it means that even countries with open capital accounts and fixed exchange rates can have limited monetary policy autonomy, right? Public credit markets, they answer only to domestic conditions. They do not answer to global conditions. So that's kind of a lever that central banks can use to allocate funds independently of what's going on outside. So that's the first finding. That's kind of a way to round the corners of the trilemma, as it's been said before. If we look at the finding on domestic credit cycles, well, it's kind of a way to, I'm showing that public credit institutions, they can be positive, they can have a positive impact on output because they alleviate the pressure, they alleviate the credit constraints on constrained borrowers, and they reduce the impact on output. In fact, I have no macroeconomic evidence. All I'm showing is the macro evidence. And all I'm saying is this macro evidence needs to be weighted against the micro debate against with Schleifer and Stiglitz on whether or not public banks can allocate funds efficiently. All I'm saying is there's not only a micro debate, there's also a macro debate. We need to take into account the macro behavior of public credit. And this macro behavior in financially developed economies, in fact, it's quite stabilizing. It's a buffer. It's not the case in financially repressed economy. So that's the key contribution. That's the key contribution. Right. I'm going to stop here, and I'm willing to take any question or if anyone has questions.
Wonderful. We have plenty of time for discussion. So thank you very much for being so tight on time. So while we give a few moments to the participants to prepare the question, may I ask you about the institutional mechanism which is behind the connection between the private credit cycle and the public credit. Because if I think of the Italian case, for example, which I know better than others, the special credit institutions, there was a very strong connection between commercial banking system and the special institutes, because the bonds issued by the special credit institutions were bought by the commercial banks. And so this is what the Italians call the double intermediation. Okay? And so to some extent, the public credit, the private credit cycle and the public credit are connected through the willingness and ability of commercial banks to fund this special credit institution. So to what extent is the Italian case special compared to the other cases you have? And if it is not so special, so if there is a connection between commercial banking system and the special credit institutions in Italy and elsewhere, what are the implications of this for the co-movement or the lack of co-movement of the two cycles?
Thank you, Stefano. So that's a great question. In most countries, indeed, private institutions funded public institutions by buying their bonds. But most of the time, they had no choice whether they would like to buy or not the bonds. The bonds of public institutions, they were included in general with the ratio of securities that had to be held by commercial banks. During the financially repressed period, for example, private banks had to hold, like, for example, 20% of their assets in a certain group of securities, and the bonds of public credit institutions were included in that. So in fact, it was kind of a captive market. Commercial banks were a captive market for public institutions' bonds. They had no choice but to buy them. The point was precisely that public institutions could get funding on cheap terms and always available. The point was precisely to disconnect the funding of public institutions from the market. So I would indeed argue that the Italian case is a special case. And I'm wondering actually if in the Italian case, the bonds of special credit institutes were not as well included in the kind of the required holding of securities by commercial banks. But that would be very interesting to say to what extent were the commercial banks able to make this ratio vary according to the credit cycles. I would say that this extent was very low in most countries, but in Italian case, it would be very interesting to investigate. Yeah. Thanks for.
Well, we have already a list of questions, so we'll start with Albrecht Richel. Also, he says it's for after the presentation. Yeah, for after the presentation. Is there a good explanation of public and private credit being synchronized, like pro-cyclical policy rules, public sector borrowing constraints, debt crisis, etc.? And the second question related to this is, would the result be the same if we take big credits out?
So can you repeat the second question? Sorry.
The second question is whether the results would be the same if you take big credits. I don't know what exactly, big credits or big loans, possibly to I don't know, large public enterprises, perhaps, if you take these big credits out.
I'm going to start with the second question. So first thing, my data does not allow me to discriminate according to the size of the loan. I cannot separate small and big loans. My intuition would be that the average size of public loans is generally higher than the average size of private loans, for the reason that most of them are long-term, and that long-term loans tend to be big loans. They're loans to finance investment, like mortgage loans for companies. I have no expectation as to what it would do to my result if I were to remove big loans, as you say. I don't know what's your prior on this question, but one sure thing is that I cannot do it. And the second thing is, you're right, for the explanation of this pattern right here, they can be different explanation than the one I put forward. There's the political institution explanation that can make sense, although I think it fails at explaining this time variation right here. You mentioned budget constraint of the public sector. Again, you would have to tell me exactly what you have in mind and how it can account for this pattern, especially like time variation. But you're right that my explanation is a tentative explanation. I do not claim in the paper that's the only factor affecting it. If you have other explanation, I'm willing to consider them.
Great. Meili Salvaro has a couple of questions. The first one is the result sensitive to the inclusion of the level of public debt?
Well, that's something that I do. It depends which result you're talking about. Are you talking about the global financial cycle? Well, I can answer anyway. So that's something I do in my robustness check. Right, I haven't included them here, but that's something I do for my robustness check for the global financial cycle. I look for heterogeneity in the response of public credits. I look at whether public credit is more or less responsive to monetary tightening by the US in different stages. And one of these stages I'm distinguishing is the level of public debt. I'm also distinguishing before and after the 1990s, or according to the size of the public credit sector. I'm using different dummies to kind of see if this response is homogeneous across my sample. And the answer is yes. The answer is yes. I do not do any robustness check like this for the domestic credit cycles part of the. I'm not sure if that would be. Anyway, that's something that I can
yeah.
do quite easily. Yeah.
Another question by Simon. If you have any analysis of different behavior or different effects of giving public credit to private business rather than giving it to households, for example.
Again, that would be nice to be able to disentangle between loans to households and loans to private business, but that's something I cannot do. I could perhaps try doing it for a few countries and for a limited time period. That could be, I guess, one robustness check, but that would never ever cover the whole sample. But I could try doing this in a robustness check.
Mm. And the second question by May is, she says, long-term loans were not always provided by the public. This is rather a situation typical of post-1945. Do you have any insights on how your initial situation of complementary institutions came to be, how this complementarity between public and private institutions emerged? Could it be that the complement situation is a consequence of capital controls in the post-war era?
Right. Thank you for this question. So indeed, you're absolutely right. Like the monopoly of public institutions, the almost monopoly of public institutions on long-term loans is a specificity of the post-war era. That's exactly what I say. And it's gone in the 1990s when commercial banks are allowed to lend long-term and stock and bond markets are not repressed anymore. I would say that the starting point is really the Second World War, right? There's some public credit before the interwar, but the starting point is the Second World War and the reconstruction during the 1960s and 50s and 60s. The reason for this is that there's essentially no private capital available, so the state has to step in to coordinate reconstruction and takeoff. And it kind of persists all the way in the 1970s, 80s, 90s, because it's a tool for the state to kind of orchestrate reconstruction. So I would say really like the starting point, and it shows in the data, the starting point is the Second World War. Like the golden age of public credit is definitely the 1950s and 1960s. So yeah, that would be the answer to this question.
Okay, Chris Meissner, he has a question about trend versus cycles and substitutes versus complements. What you can show is a change in the cyclical properties of public credit. But if these public flows are declining in absolute value or as a share of total credit, how might this affect the interpretation of the change from complements to substitutes? And also, the substitute complement interpretation seems to be a demand side interpretation. What about crowding out or the supply of credit?
Right, excellent question. So I'll start with the second part of the question, the crowding out. I fail to see how they could be, well, I guess I cannot answer completely your question, but I fail to see how they could be crowding out in a time when precisely no private bank wants to loan. Like the private bust, it's a time where private banks do not want to loan to even the safest borrowers. So in this kind of time, I would expect more crowding in. And there's a review of economic studies paper by Jimenez and co-authors showing exactly this on the case of Spain in 2008. that banks during the private bust that receive a public loans are more likely to get a private loan because it stabilizes the borrower and it makes it like kind of decrease the information symmetry. So I would expect crowding in rather than crowding out during the bust, precisely because it's during the bust. That's for the crowding in, crowding out part. As for the trends, that's a good point. That's a good point. Actually, the declining trend that you see here is as a share of GDP. So in level, it's never really declining except in special circumstances like this reform, or in Greece. In level, it's never really declining. Does that answer completely your question? No. How could I control? Do you have any suggestions? I guess we can come back to this.
If Mark can unmute Chris, because I can't find where I can do that myself.
I have unmuted Chris Meissner if he wants to come in.
Oh yeah. Okay. Sorry. Yeah. Hi. Yeah. I don't know if I have any suggestions. I just, I mean, the graph you just showed there, it says it's a public credit as a share of total credit. So it does look like it's definitely declining. If it's not, if it's getting smaller and smaller, I fail to see how it could play such a stabilizing role. So I don't know, how to think about, the trends versus the cycles here. You're saying you're giving them like more bang for the buck. Well, I don't know what to do with it, but it seems like an issue.
Mm-hmm. Okay, yeah, that's a good point. I'm taking the point.
Yeah, there was an initial question, which is rather a suggestion by Tai Kwang Oh. The suggestion is that there is a recent paper by EHESS Martin and Dolfville, difference estimators of intertemporal treatment effect, that shows that the panel data version of the local projection method of Jordan for time series may produce biased estimates of the treatment's instantaneous and dynamic effects if the effects are heterogeneous across groups and over time. And so this paper provides an alternative estimator which may serve as a robustness check.
Right. Just before answering this question, coming back to the question of Chris again. So sorry, it's not in percent. Yeah, Stefano. Yeah. No. So here, public credit is not in percent of GDP, but of total credit. So the fact that it's declining does not mean that public credit is declining, just that it's growing less than private credit. Here, for example, in the 1970s and 80s, 90s in France, it's not declining public credit. It's just growing less than private credit. If the growth rate of public credit is below the growth rate of private credit, then the ratio declines, right? The decline is level, again, is specific to certain very precise events. This event here, this event here. The public credit almost never declines in level, okay? To be sure, like the growth rate of public credit sometimes is, the trend is inferior to the trend of private credit. So I think that kind of nuance what you just said, but I'm going to think more into that. As for the local projection comments, you mentioned heterogeneity. Well, heterogeneity is something I specifically check in my robustness check. While Maëlys mentioned like have you checked for the level of public debt. So I interact my shock variable with as many dummies I can think of, and that dummies that can make sense. So I specifically check for heterogeneity in the response of both private and public credit. So I think this is not a problem. Another way I could check this is not using local projection, of course. It's just like doing a VR or something like this. So I guess I could show this in my robustness check. Yeah.
There is a comment from Claudio Gonzalez Vega. He says, in some countries, especially, for example, Mexico or Indonesia, a very small percentage of public credit goes to small or credit ration borrowers. So large and wealthy borrowers capture a very large share of loan portfolio. This is connected to a question I also had, because, for example, if I think of the Italian case, the special credit institutions were lending to large business, private and public, for large infrastructure projects or network public utilities. So this idea that in the post-war, this special credit, this public credit is targeting mainly credit ration or potentially credit ration borrowers seems to be a little bit at odds with the experience of many countries. Italy is a case, Latin America can be another one. So what can you say about this?
Okay, so first thing, in the 1950s, pretty much everyone was credit constrained, right? Because it was not possible to get loan from a private bank. Like private finance was just not available. So for the comment on Mexico, yes, I take your point. And in fact, if you look at this kind of graph, in the case of Mexico, it's very, very procyclical, very, very, very procyclical. So my explanation of public finance being a substitute to private finance explains why it's countercyclical, not why it's procyclical. For the case of Italy, that you mentioned, yes, okay. So maybe need to nuance the thing that it was only small borrowers. I do not explicitly say small borrower in the article. I need to be more precise. But taking the case of Italy, do these large companies that receive public loans could also receive a loan from a long-term loan from a private bank? Could it be the case? If yes, then I need to be more precise about my argument. If not, yeah, okay. Then I need to probably investigate the Italian case.
Yeah. Okay, another question by Pamphili Antipa, who thanks you for a very interesting presentation. The question is about magnitudes. You show a graph according to which overall credit declines by half when including public credit. However, public credit accounts only for a little over 20%. So the dampening effect of including public credit looks rather large.
Right. Well, it's not proportional, right? It's because the response is the growth rate. It's the growth rate, the response. It's not the level. If the response was level, you would indeed expect the response of total credit to be half, only if the public credit is half the size of total credit. But here the response is not in level; it's in growth rate, so it's no longer proportional. That's one thing. And another way of explaining this could be a crowding in. Again, it could be that the fact that public credit does not respond to the shock on the U.S. interest rate actually kind of tames the response of private credit as well. So there's a direct effect on public credit and an indirect effect on private credit, which explains this. But again, don't think that in order for the response of total credit to be half of that of private credits, public credit needs to be 50% of total credit. That's only the case if the regression is in level, not the growth rate. But a good point.
Yeah. Okay, we have another couple of questions. One again from Albrecht. He says that loans to small business in many countries used to be allocated via the public saving banking system. And the dismantling of that system might help explain the time variation. What is your opinion about that?
How could it explain the time variation? Savings banks granting loans to small borrowers, and the dismantling of this, I guess, in the 1990s could explain the time variation. I don't really see the intuition there. Perhaps if you could like precise it a bit, maybe it's obvious, but I don't see the intuition.
Okay, and another comment by Albrecht is figure 6 makes good sense if we assume that some governments have good access to borrowing during recessions, for example, Germany, while others, for example, Greece or Indonesia, do not. Might that be a good point?
Well, yes, but again, it's not only about. It's not really about being able to lend. It's about being willing to lend, because it's been shown that during the bust, the problem is not really that private banks cannot lend. It's that they do not want to lend. So it's not only about whether like they're able or not to borrow to then be able to lend back. It's about what's their incentives. Like private banks, they want to minimize loss, so during a bust they do not lend. Okay, public banks, well, they're public, so they have kind of the incentive to have another rationale. So I don't think it's only about whether they're able to fund themselves. It's also about whether they're willing to use the funds they have available to lend. So that's two things. But you're right that the ability to borrow could participate to this. Yeah. That's a good point. I take your point, but I don't think it's the main thing here. But I take your point.
Well, we have just 3 minutes for the last questions. There is a comment by Mailish again about foreign lending. She says that American banks were also involved in long-term lending and investing, at least in Europe, to the annoyance of the Gulf, for example. Do you have any measure of foreign lending in your
domestic loans only, I'm afraid. So all these questions, disentangling between households and firms, disentangling between domestic and foreign, or between the currency denomination, are very good questions. But as the database is, I cannot answer this question. The thing I could do, of course, is just focus on 1 or 2 countries and provide a tentative answer to this question. I could try to disaggregate a bit more my data for 1 or 2 countries, but so far I don't have an answer to your question.
Okay, I think that we have more or less answered your question. I had just last one about the synchronization of public and private credit in the pre-liberalization period. What about orientative planning, which was a policy framework which was used by many European countries, at least. Greece is a case, Italy is another case. So to what extent this synchronization, this procyclicality of public credit is a consequence of a very strong political command on the allocation and the magnitude of credit in some countries.
Well, I think that's a very good point. Actually, my explanation can explain very well this pattern after financial liberalization. It does not explain very well why they're very pro-cyclical before financial liberalization. You need something in addition to your model to kind of generate this. And what you said, it could absolutely be the thing, is that before financial liberalization, private finance is not that private, meaning that commercial banks, they're very restricted by the states, meaning in fact that I think these cycles are pretty much orchestrated by the states. So that could be absolutely one way of generating this pattern in this cycle. Again, my idea of substitution between private and public loans is definitely not working here, because there's market segmentation. It's working here, but it's not very good at explaining this procyclicality here. So your explanation is definitely a very good point. That's what I believe personally, but you might not care about what I believe personally. But yeah, I agree with this. Yeah.
Okay, it's 6 o'clock, so we must draw this the formal session to a close. We thank Victor for his very nice and interesting presentation. We thank all the participants for a very lively discussion. Before we leave or we close this first part of the seminar, let me remind you that the next seminar will be in 2 weeks on September 27, and we will have Björn Bray from Université Libre de Bruxelles and Giovanni Facchini from Milan University with a paper on the consequence of a trade collapse, economics and politics in Weimar, Germany.
Thank you very much for the question.
Yeah. And now we have 15 extra minutes for continuing the discussion. So if
I have a couple of questions.
yes.
Yeah.
Yes, for you.
Hi,
Go on.
Victor. Thanks. Great job and beautiful data. So a question that sort of piggybacks on Melis's last, right? She opened up to the international arena.
Mm-hmm.
I know anecdotally that some of this public credit granted through special credit institutions was actually co-funded through the World Bank and international development banks, right? So I know this is for Italy, right? The Casa per Mezzogiorno until the 1960s drew a big chunk of its funding directly from the European Development Bank, not from the Italian state, right? So you know, using the usual terminology of treatment effects, I'm not really sure what the treatment might be here, right? It might just be an extension of international funding to developing and emerging nations rather than the admirable counter-cyclical properties of domestically generated state credit. And then perhaps a way of indirectly checking this, right? Running a couple more regressions, this time to see which one is a better predictor of financial crisis, private or public credit, right? Because financial crises don't necessarily have to come immediately at the end of the bust of a private credit boom. They can be extended, right? As we discovered more or less recently with the global financial crisis, by the intervention of the state sector, right? The official sector is trying to patch up things and that ends up making it even worse.
Right. Yeah. So for the funding by foreign agencies, yeah, that's a very good point. Again, that's a very good point. Can I control for this in any kind of way? I'm not sure, but then you would explain for your story to explain this pattern. You would explain why funding by the World Bank would increase during bust, and even if it did increase during bust, it doesn't explain why would the public credit institution would be willing to lend all these funds during the bust. I don't see the full picture here, but perhaps because I don't understand it fully. It's probably because I don't understand it fully. Second thing, for running regressions predicting financial crisis, I did. The thing is, I have 13 countries in quite a not that large sample, so that I don't have many financial crises. I have like 15 financial crises or so in my sample, but there's not much I can do with heterogeneity, right? If I split 15 into 2, that's 2 samples of 7 crises. If the regressions don't look great, I'm not gonna lie, the regressions don't. I could think of a way like taking an extended definition of financial crisis, could still try to do something with this. It's definitely interesting because you see, for example, in Mexico, someone mentioned Mexico earlier, in the 1960s or 70s, actually the sovereign debt crisis and the banking crisis, they're much better predicted by public credit than by private credit, which kind of supports what you're just saying. Whether I can show it in a systematic empirical way, maybe I can try again to see if I can have robust results. But
no. I mean, I want to be fair. You've done a lot already, right? But once you do a lot, yeah, we become greedy and we want to see more. So
no, but that's a good point. That's a good point. Yeah.
Nathan has some questions as well.
Yeah, I see Nathan has a question, and also I see in the list Albrecht raised his hands. So if Mark can unmute him, yeah, you are. So Nathan.
Okay, so I'll go first. Thank you, Victor, for the presentation. Great data. It's just a comment in terms of the kind of the setup of this exercise. So there's this literature about the role of central banks, especially in Europe in this period, as sort of development banks in some sense. So there were kind of And then kind of putting in the same bag the United States, which never assumed that role, and most of the activity of the Fed was indeed counter-cyclical. So there were, so is there, I mean, I didn't look at the exact econometric specifications, but you control for these different mandates of, say, at least central banks as sources of credit. So because that could explain part of what's going on in some countries where the mandates of central banks change from sort of more development banks to, in the 70s after the inflations, kind of to control inflation, and therefore they changed the mandates and then inflation targeting furthermore. So
that's a good point. I could definitely do that, but do you have a way of like of dummying what you're saying, like of doing a 0-1 coding of what you're saying? If there is a way that's not too arbitrary, I'm perfectly willing to try. That's a good point. That makes sense what you're saying. So
I mean, you looked at central bank balance sheets, and it's probably, I mean, so there's the total public credit, but you could make a distinction between central banks because they're also maybe coordinating all this on the local, and they would have these things in their balance sheets directly, not just as an archival source for what's happening in the economy, but what's on their balance sheets. That could be. So it could be either, so this could be a way to sort of extract this from the data. I don't know how many central banks have kind of written histories of central banks and so forth, where they kind of give you dates for these types of policy changes or whatever. But at least from the data, I think you can see whether this is the case, because I know there is this literature about these development the central banks as development banks.
That's a good point. That's a good point. Yeah, I think Eric Monet, I think knows a lot about this, so probably has some good tips on this one. But yeah, that's a good point. That's a good point.
Albrecht.
Yeah, thanks. Can you hear me?
Yep.
Yeah.
I was wondering about one thing. I mean, you do what seems to be a very good, but in a way narrow exercise, and I have the impression that once we leave that domain, we get into things that you haven't thought about very much, if I may say so. Sorry, this is not very polite.
No, of course.
But as you will be on the job market, I understand that's your job market, part of your job market package. Is that right?
Probably.
Yeah, it will be a good idea for you to kind of widen the focus a little bit, so that you can basically easily take on board such issues. Basically, what many of the consumers of what you do will want to know about is which factors other than monetary policies may have influenced in that. Now, I haven't read the paper. I just heard your presentation, but I have the impression that you focused very much on monetary factors, which is super interesting. But of course, there are the other things as well. So let's say credit policy regimes, public control of the banking sector. These are things that could perhaps be dummied, as you are saying, dummied quite easily. You've done this perhaps already, but I would encourage you to do a little bit more. Then level of public debt, access to foreign credit. This is something that came up several times. It would be great if you could control for that, at least dummy for that. Because, for instance, I had this case of Figure 6, where you show Germany and Greece and Indonesia. I'd be very surprised if this could not be explained by lack of access to foreign borrowing by the Greek and Indonesian government. But I might be totally wrong. But people will think of such things, and then you want to be able to give a good answer. Okay?
Yeah, of course.
I know it's a bit unfair. I know it's a bit unfair because everybody is basically asking you about things outside the comfort zone of your paper, which you can take as a compliment because it only shows that what you do is important.
No, of course. The dumbing exercise, as we now call it, I've done it a lot for the global financial results. I've not done it for what you see right here, the domestic credit cycles. And yeah. And indeed, from all these things back, what I get is that, yeah, putting forward one single explanation of why is it that we see what we see for Greece, for example, is a bit risky. It's a bit risky because I have no way of showing that is indeed my explanation rather than another one that's valid. So either I can like dummy all these things out.
Oh, that's clear. Yeah, that's clear. Of course, that's entirely clear. You shouldn't try to explain every outlier. We are entirely agreed on that. The thing is only people will push you towards these banking and debt explanations, which were perhaps not exactly the focus of what you were interested in.
Yeah. But that's a good point. I think all the comments go pretty much in the same direction. So yeah, that's a good point.
Yeah, we have a few minutes left, and so I wanted to say a word of caution about your assumption that there was a very clear segmentation between long-term and short-term credit. In many cases, again, Italy pops up again as an interesting case. Commercial banks were formally extending short loans, but the practice was to renew them virtually automatically. And so what was formerly short was, as a matter of fact, long-term loans. And so before liberalization, even more so in the Italian case, where most of the banking system, of the commercial banking system, was in the hands of the state indirectly through the IRI. And so you can easily say that all credit in Italy was public as far as the source is concerned for a very long period till the early 1990s. And yeah, related to this, I wonder to what extent the countercyclicality you observe after liberalization might be driven or affected by regulation. Okay, so imagine that the private banking system subscribes bonds issued by the public credit institutions, which are very liquid, have a guarantee, a subsidy, and so they are very good from prudential from the perspective of prudential regulation, especially if you are in a downturn of the credit cycle. So do you have any insight on the possible impact of regulatory issues on this?
No, that's a very good point, but again, that would explain, and I think it is the case, why public institutions receive a lot of funding during the bust. Of course, during the bust, people are more willing to deposit their money at public institutions than at private institutions, of course. But it does not explain why they would be willing to lend this money. Looking back at the Bernanke paper, for example, on the Great Depression, it's clearly shown that even in the Great Depression, the problem was not a lack of money on the part of financial institutions, but they're just not willing to lend, except to like the A borrowers. So it's more, I think, an incentive issue. It's not a lack of funds. So of course, I think the funding pattern is also countercyclical. Like people deposit less their money in private banks during downturn and more during upturn. And I think it's the opposite in public banks. I cannot show this, but it's been documented by other papers using microdata. So what you say is true. What you say is definitely true. But to me, it doesn't explain this lending pattern. Like the liability side does not necessarily explain the asset side, because they must be willingness to lend in between. And I think that's where the political thing comes in, is that public banks, they have a public charter, they have a public mandate, and they kind of need to support the economy at some point. So to me, this countercyclical funding pattern does not automatically lead to a countercyclical lending pattern. I think it's pretty clear from a theoretical perspective. From a data perspective, I'm not sure I can do much. But again, I agree that the funding pattern of public credit institution is countercyclical. It's been shown by other than me. I agree with this. And it might depend on the regulatory framework. I also agree with this.
Okay, wonderful. It is 6:15, and we can just say goodbye to everybody. It was very nice paper, very nice discussion. So I enjoyed it very much. Best of luck for your postdoc.
Thank you very much.
In the US.
Thanks, Victor.
Comments.
Thanks, Victor. Good luck.
Enjoy Princeton.
Take care.
Thank you very much.
Bye-bye.